Hello, this is Mike from Marlin Financial Advisors. I'm going to show you a free tool you can use. I pay for it. I'm going to provide it to you via link through either in the comments or the details section that you can use, and you can put in your info and use this Roth conversion simulator yourself. And I'm going to walk through it real quick, and hopefully that can provide you some sort of help. If you have any questions on it or anything, reach out. If you do find use out of it, please let me know. Post a comment or like the video so I know that people are actually getting good use out of this. But okay, let's look. So I've made a test account. They have, $1 million, and they have some pension income and uh, some expenses and everything. So this is the plan, right? That they have, and basically their income just creeps up with inflation as they go, and then here RMDs start, right? So in general with Roth conversions, this RMD spike is what gets everyone in trouble. Now, if you don't have that in your plan, you probably don't really need to do Roth conversions very much. But that's what we're trying to get rid of a lot of times in Roth conversions, this spike. You can see right at the end here, it pushes them into a higher tax bracket, which means they're now paying 22% instead of 12, right? So if we can stop them from paying 22 out here and only pay 12, then that's the win, right? Because you save 10% on taxes for that amount of money. Now, it's not very much money for this test account, right? There's a very small spike, but for some people, it can be a much larger spike. And that can be more of an issue. But even a small spike like this will actually have a pretty good effect on this, how much more money you save. Now, if you don't know the withdrawal sequence that is most preferred, mathematically, 99% of the time is going to be you take from your taxable account, then you take from your tax deferred account, which is 401k and IRA, then you would take from your tax-free account, which is Roth. This test account does not have those other accounts. It just has $1 million in a 401k to keep it simple. So that doesn't really matter here. But you can obviously play around with how you would like to take out your money, and you can put your plan in, what you've originally thought you wanted to do, and then play around with this, and you can see how big of a difference it'll make. But for this test, it won't do anything for their plan. Now, this is where we want to focus, right? So this is basically going to tell you if you did a Roth conversion and you filled up the bucket, you filled up your 10% tax bracket, what would it do? Well, here wouldn't do anything because you're above the 10% tax bracket, so there's nothing to fill up, right? Now, what if we said we want to fill up the 12% tax bracket, which will soon be the 15? Okay, now you can see this green shaded area. The green shaded area is the Roth conversion. So your income is the blue line here, and then you're going to also convert above that until you fill up this 12% bracket. And what that's going to do is, you can kind of see this light blue shade. It's going to stop you from paying those higher taxes in the future. So you only ever pay 12% instead of out here you're paying 22 on some money. And then eventually it's estimating, right? This is all based on your portfolio and how fast it's going to grow and different things like that. It's basically saying around 81, you should be done with conversions. And then everything's in Roth, right? And so you can see, okay, it's led to $1 million more, which this is not inflation adjusted, so it could be possibly a lot less money. And you can see, okay, there's some value here. Now let's see, what if we did 22, right? There's still some value, but it's not the highest number, right? We want to look for the highest number. And then obviously this is fluid, so each year this could change depending on how the markets do, different things like that. But good general sense. Okay, well, if you fill up, the bracket you're in right now, that seems to be a really great idea. Okay. And then let's see, we can go to comparison here. So when you create your account, you'll go to the tax tab, and then you'll go to distributions, and you'll get this. Let's go to comparison. I want to show you something else I like. This is federal taxes paid. So you actually pay more taxes. No, the proposed strategy here. So you pay about $335 in total taxes, where here you pay about $377, and that's in your lifetime. That has nothing to do with your heirs, okay? So you would save about 40 grand in taxes, and then therefore that 40 grand can grow and you can have a lot more money. And that's how we kind of get to these numbers. This number, though, this is tax adjusted ending portfolio value. that takes into consideration your heirs tax bracket. Okay, so that's why that's really high number, is because it's saying, okay, you saved $40,000 in taxes, which that grows, and your heirs don't have to pay any taxes. So that's why this number is super high. Fortunately, I don't know how to change that. I wish we had a couple different numbers there, but the only other thing to notice is, here, let's do this. So that would be it, ignoring your heirs. So $700,000 more dollars, because you save 40 grand in taxes, that can grow to this much money by basically within 30 years, with inflation. So inflation adjusted, it's probably more like $300,000 of portfolio size that's added in your plan. The other thing you should know is, I've been talking about your heirs. This is your estimated terminal tax rate. That's the tax rate of your heirs. If you have no heirs and you don't care what taxes they pay, then you put it at 0, and that gives you just the benefit for you. I usually like to have it about 15%. Obviously, if you know what your kids or whoever's going to get the money, their tax rate would be, you can move this around. Obviously, the higher tax rate they're in, the more the software is going to want you to do conversions. The lower, the less. But I'm going to keep it around 15 because I think that's fair. Last thing to mention, you can look at the capital gains brackets, and you can fill up different capital gains brackets. This is actually just coincidentally right around where the 12% is, so it basically gives you the same number. And you can fill up this, and then you could do it also based on Medicare. Say you never want to pay a Medicare premium, we can mess around with a couple things in here. Say no IRMA surcharge, and see what that would do. But in this case, right, we find ordinary income at about the 12% bracket. So filling up the bracket they're in right now would provide them the most return based on this simulation. Hopefully that it's helpful. Obviously, you can reach out to me anytime for help, free of charge, of course. And if you do find this helpful, please comment that you found it helpful or like it, so people know that this has helped them and they should take a look at it too. Okay, take care.